Hi everybody, it's PJ Patterson from Keystone Financial, and I've recently had clients asking me about gold and why we should own it, how it should be owned, and just generally a conversation about the importance of or why it's important to have gold in your portfolio. So this video blog is going to be all about gold and investing in gold. I hope you enjoy it. So what we're going to do is cover off three main things: what gold is, why you should own it, and the four ways that I think are the best, most appropriate ways to own gold. So first of all, what is gold? Well, in my hand, it's going to be hard for you to see this, but in my hand I've got a 2-ounce ingot of gold. Now this is pure gold. It's stamped ABC bullion is where I buy my gold in Sydney. When I buy physical gold, this is physical gold. And it's 2 ounces. That's a little 2-ounce ingot. Now that ingot is worth, at today's price, about 3,400 Australian dollars. So today's gold price, when I checked today, it's trading somewhere around 1,700 Aussie dollars an ounce. And so basically gold is money. And the important thing that you need to understand about gold is for the last 4,000 or 5,000 years, gold has been money. Everything else is currency, and to illustrate that, in my hand I've got currencies. That right there represents currencies from about 6 or 7 different nations. So I've got some Singapore dollars, I've got some Malaysian currency, I have some Vietnamese currency. Actually, here's a Malaysian currency, only got singles from Malaysia. I've got currency from the Philippines. I've traveled to the Philippines. I've got staff over there. And I've got some Emirates from the United Arab Emirates, some of their currency. I traveled there recently. And I have, of course, there's a $100 C note from the US, a $100 US note. And then finally, I've got some of our lovely, colorful Australian dollars. There's about $100 worth of Australian money. And isn't it interesting when you look at currency, that first of all of that stuff is colored paper. That's all it is. Colored paper, colored plastic. But when you look at gold, it is something tangible, it's physical. And this is a real important lesson that you need to understand about gold being money. Money has realistically 7 different attributes, and they are as follows. First of all, they need to be generally accepted. So you could argue that currency, like that $100 note right there, US dollar note, could be money because it's accepted worldwide. So the global reserve currency is the US dollar. If you took this $100 note to pretty much any country in the world, they would accept it. So it ticks the box for being money. It needs to also be portable. So same deal. Is this portable? Yes, I could put this folded up, put it in my pocket, I could take it with me, and it could be used again anywhere in the world. Portable. Next, it has to be durable or indestructible. Now this is where we start to run into problems with currencies like the US dollar or Australian money, right? It's plastic. Now if I set either of these two things on fire, they're gonna melt, right? Or I could rip that $100 note in half, which I'm not going to do because $100 US is pretty valuable these days. But anyway, if I ripped it in half, I could destroy it. So I could destroy the currency versus this hunk of metal has been or was in the Earth's crust for probably a few 100 million years, and somebody dug that gold up, I don't know where from, but dug that up, melted it down into that little ingot, and for me to destroy this, I can't destroy it, right? I can only melt it down and change it into smaller amounts or whatever. So it's very durable, it's very much, this little ingot of gold is going to be in existence for many, many thousands of years more, in its little life cycle. It needs to be homogenous as well. So what that basically means is that the item, like a US dollar, it needs to be, or US note, it needs to be standard across the note series. So you've got $100 bills, you've got 50s, you've got 20s, you've got 5s, 10s, singles, etc. And most currencies have that attribute as well. They're homogenous. So they all look the same. They have, well, not look the same per se, but they all are very similar in shape and size and denomination. They also need to be divisible. So you need to be able to break them down into individual units or smaller units. And of course, currencies do that because they come in different denominations. They also need to be malleable. Now again, this is where currencies run into trouble with being money, is this little ingot is malleable. It's stamped. I could take a hammer and I could start beating that into smaller pieces. I could melt it down and change into smaller chunks of gold, smaller ounces or grams. So it needs to be malleable. That's another attribute of money. It needs to be cognizable. I'm not even sure if that's a word, but anyway, it needs to be recognized as something. So when I flash a $100 note, people are going to recognize that. They're going, oh, that's US dollars. Not Uncle Sam, sorry, Benjamin Franklin is on the $100 note. And likewise with Australian currency, people are going to generally recognize that. Maybe not all over the world, but certainly in many parts of the world, they'll recognize that. They'll also recognize this little ingot as being gold. Finally, and this is most important, so all of those other things I listed, generally accepted, portable, indestructible, homogenous, divisible, malleable, cognizable, I think I've said that word wrong twice, are all more or less attributes that you get from a currency. A couple of them are a little iffy, like the destructible. Coins probably better than notes, because notes do get destroyed easily. Coins would have much more durability. But the final thing, and this is the most important attribute of money, is it needs to be a store of value. Now, I'm going to give you a little example. If I gave you today this $100 US note, and I gave you this 2-ounce bar of gold. Now, they're not equal in value, no way. So let's say I gave you $100 worth of gold. Pretend that's $100 worth of gold, even though we know it's about $1,230 US dollars. No, sorry, $2,400 US dollars worth of gold right there in that 2 ounces. If I gave you the equivalent in US currency, and we put that into a box, and we buried it in the ground, in 100 years' time, which one would you rather have? Now, I'm sure most of you have figured this out already. You'd rather have the gold, because hard assets like gold, diamonds, silver. Actually, let me show you some silver. There is a 100 kilo bar, sorry, a 1 kilo bar. I wish it was a 100 kilo bar. A 1 kilo bar of silver. Same attributes as gold. This is money as well. As you can see though, and this is not worth, this would be worth about $50, $60, something like that right now. But as you can see, that's a more concentrated store of wealth than that is. It takes a lot more silver to equate to gold. That's why the two things have always been money, but gold has had a much higher recognition of wealth, because it's more rare basically than silver. So anyway, back to being a store of value. Which one would you rather have in the box? You'd rather open that box and be happy to see the gold ingot or the gold bar or even that silver bit of silver there, because it's going to have stored value over time. The problem with currency is that it can be printed. And that's exactly what the central banks have been doing, is they've been printing a lot of this stuff. All currencies are being debased. It's very difficult. You can't print that. You have to dig that out of the ground, that bit of silver. You have to dig it out of the ground, refine it, put it in this bar, and then store it. Much harder to do that. Therefore, it has value, it has economic value, and it has the ability to store wealth over time. And that's really what gold and owning gold is all about, is it is a store of value. And just so I'm clear, when I say gold, I also mean silver. So silver and gold throughout history have been equated as money. Everything else is currency. So that's the first thing you need to understand about gold, and the argument around owning gold or silver is that they're money. They're not currency. They are used as and can be used as currency, but the most important thing about them is they're a store of value. Now, let me get into why you should own it. So I've really already touched on that. Number one, and the number one reason why you own metals is they are a store of value. They will protect you against the debasement of currencies like the US dollar. And so because of that, you want to have a portion of your wealth stored in assets, and gold and silver aren't the only ones, but stored in assets that will be a store of value. Now, you can make the argument that that is also things like real estate and other types of investments, shares, etc. But in its purest form, this guy right here is absolutely going to, over the long term, be a preservation of wealth. The second main reason, and it flows from that preservation of wealth argument and the currency argument that I was just making, is that inflation erodes purchasing power. So if I had a $100 note, a US dollar, $100 US note 100 years ago, I would have had a lot of money. So in say 1920, if I had a bunch of these in my wallet, I would have been a pretty, well-off guy, because everything back then was inexpensive. You could get a cup of coffee for 5 cents. You could go to the movies for a quarter and all this sort of thing. So $100 in say 1920 was a significant amount of money to have and be carrying around. Whereas today, $100 is barely going to get you and your partner or your family dinner out somewhere at a restaurant. However, if you had owned gold over that period of time, it would have kept pace with the value of this gold ingot, would have kept pace with the inflation. So inflation is actually an increase in the money supply. People think that inflation is rising prices. That is the result of an increasing money supply. Now, I'm going to get too much into money supply and economics around money, but just know that inflation is actually the growth of the money supply. And deflation, by the contrary, is exactly the opposite. It deflates. It's the contraction of the money supply. The third thing reason that you need to own gold is that it's a good portfolio diversifier. So I know a lot of people, because a lot of my clients, they have property, they have shares, they have other assets, they might have classic cars, might have some artwork. So it's good to diversify your portfolio. And I recommend to own in physical format, maybe 2 to 5% of your entire asset base should be held in physical format. So physical ingots like this that you can actually go and touch and feel. Now, obviously you would store that somewhere safe, like a safe deposit box, or preferably in a private vault. But you should have 2 to 5% of your assets in something like this. The final thing is that I love about the metals is that everything on our planet really has something called counterparty risk. So think of it this way. When you put that $100 note on deposit with the bank, it's an asset to you on your balance sheet, but on the bank's balance sheet, that $100 note is actually a liability. They owe this to you as the depositor. So they have to make good on their promise when they take the deposit in as a fiduciary. They have to make good on their promise to give you that $100 back, or that $100 note back. When you physically have possession of gold or silver, when you physically have possession of these things, they are not simultaneously someone else's liability. No one has a claim on this. No one. No one can say that for me to get this ingot of gold, that I have to go get it from someone. It's mine. It's in my possession. Just like this currency right now is also in my possession. It's simultaneously not someone else's liability when it's in my possession. But as soon as I put it in the bank, I have to go to the bank to get it out at the ATM or from a teller. So that is really the biggest issue that I see with a lot of financial assets is there's a lot of counterparty risk. Someone has to make good on the delivery of that item. Whereas when you physically own a metal, no one has counterparty. You don't have that counterparty risk. No one has to make good on that. Now, I want to go into a couple of ways to own gold. First and foremost, and I've been demonstrating that throughout this video, is physical. You own the physical piece of metal. You go to a bullion dealer, you buy it, you give them your cash, and in exchange for that, you take your metal and you take it away. And I store mine in a vault, in the Custodian Vaults down in the city. That's the name of the company, Custodian Vaults. I store my gold there. And obviously I have this at home at the moment because I needed to shoot this video, but as soon as I'm done with this, I will get it back into a place where it's safe, where there's safekeeping and storage, and it will just be under lock and key until I actually need it for something. The second big way that I love owning gold is through the mining shares, the gold mining stocks. Now, this is a much riskier area because a lot of mining companies, because they are companies and they're businesses, obviously there's more risk in that. There's zero risk in me owning this. This ingot of gold will have value for the rest of history, for the rest of time. As long as human beings populate this planet, this item will have some value. I don't know what it will have, but it will have some value. Whereas something like the US dollar, it's decreasing in value all the time. But with shares, because they're businesses, there are issues that can arise. You can have financial problems with businesses. They might go bankrupt. They might over leverage. There's a number of reasons. So you have to be very careful when you're investing in things like the mining shares. But the one main reason I love the mining shares is because they get you leverage against the thing that they mine. So they'll give you leverage against gold. What do I mean by that? Well, a miner or a producer of gold will own the gold in the ground. They already have the proven reserves. They've drilled it out. They know that it's there. And now all they're doing is extracting that gold and turning it into this little ingot that I've just dropped on the floor. But here's another one, this little ingot. That's what was in the ground. And so when you know that from a mining company that have gold in the ground and they're extracting it and they're mining it, there's a cost to mine it. And anything above that cost to mine is profit for that company. Now, the cost to mine gold right now in Australia, it does vary by company and where their assets are and where the mines are. But let's just, for argument's sake, say it's 1,000 Australian dollars per ounce to all in. That's all in costs to mine an ounce of gold. So an ounce of gold, as I said in the beginning of this video, is trading for about 1,700 Aussie dollars an ounce. So that means that that company has $700 of profit per ounce when they mine it. And my expectation is that gold will continue to rise for a number of reasons, but every single dollar above their all-in sustaining costs to produce that ounce of gold is profit to that company. So very, very powerful leverage. And you get that leverage without having to borrow any money. So most people think leverage is borrowing money and putting that into the share market or whatever. But in this case, you can buy a share of a gold company without borrowing any money, and you get instant leverage to the gold price. So very, very powerful way to invest in gold. Thirdly, you can buy your physical gold through companies that provide an online service. And one of the companies that I use and recommend to my clients is called Gold Money. And very similar in taking physical possession. You actually don't end up taking physical possession of the actual gold. They store it on your behalf, but you have ownership of physical gold stored in one of their vaults. Now, this raises again that counterparty risk issue where you still have to go get it from them or get it delivered from them, which raises that counterparty risk issue. But the good news is with a company like Gold Money, they do own the physical metal in their vaults, and it's allocated to you. The fourth way, and this is really the final way that I like around owning gold, is to buy an ETF, an exchange traded fund, where gold is the sole holding, or silver would be the sole holding. And there's a couple of ETFs in Australia that do that, and that is one possible way for you to also own gold and silver. So today I've gone through a number of things about gold and silver. I've talked with you about about what money is. So money is something real, it's something tangible, and there's those 7 attributes of money. Go back through those, you can Google those, you can learn all about them. The main thing is store of value. That's the one main thing you need to remember about money. Everything else is currency. We went through currencies. There's the US $100 note again. This thing loses value like nobody's business. It is being printed right now with reckless abandon and will probably continue to do so. So its value is constantly declining, whereas the value of gold and silver, yes, while it does fluctuate, it is rising over time, over that same time frame. The second thing we talked about was why you should own it. So we went through the hedge, that it's a hedge against inflation, that it is a great portfolio diversifier, and finally, it doesn't have any counterparty risk, especially when you own the physical metal. And then finally, we just discussed a couple of ways that you can own gold. I really hope this has been a valuable video for you and explained a bit more about investing in gold and silver. If you have any questions, please be sure to put those in the comments. You can reach out to my business directly, or you can give us a call. Remember too, to like, share, and comment on this video. Thank you.